Thanksgiving is right in front of us, which is also a good time of the year as we head into an earnings season that was really very good. The Dow Jones, of course, closed over 36,000 on Friday afternoon, but there was a bit of a deceleration in the economy. The Commerce Department had 2% annual pace in the third quarter, and that was a slowing down. There could be a lot of reasons for that, Derek, but we can't get away from the big definition that everyone's talking about, and that is inflation.
Right. I mean, despite all the inflationary signs that we saw this week, the S&P is within 1% of its all-time high. So clearly investors are looking past that for the moment. But on Tuesday, we got a much harder than expected PPI, up 8.6% versus levels from a year ago.
8.6% in PPI, which is different than CPI, but it's an inflation number that was very high.
That's right. And then that was confirmed essentially by the CPI the following day, excluding volatile food and energy. CPI was up 4.6% year over year, the largest 12-month increase in 30 years.
And, all of this leads us to where I was going with the Commerce Department's report, and consumer spending only at 1.6%, down from 12% in the second quarter. So you say, why is that happening? Why is consumer spending slowing? And, of course, we have COVID-19 Delta. We have the CPI things that are happening, and consumer spending in this country is 70% of GDP, so we have to pay attention to it. As Danny started off the show, we're heading into Christmas season, and we could see a change, and good news could be around the corner.
Well, and one of the reasons why consumer spending was weaker was because you couldn't buy things. I mean, there are any number of cars. I know any number of friends of mine that are waiting for cars to be delivered and not going to get them till the spring. So that was money that could have been spent that wasn't. So you'd assume that pent-up demand will remain provided consumers remain confident. And that's what I wanted to just go into, too. On Friday, we also saw a consumer confidence number, and it was the worst number we've seen in a decade, fueled probably by some inflation fears, because as you talk about all the time on the show, when you see inflation, it really affects lower income individuals. It's gasoline prices, it's food prices. It's really non-discretionary spending, and that can cause people's confidence in the future to decline. Yeah,
that confidence number, I saw it out of the University of Michigan Consumer Sentiment Report, and we'll know that right before the pandemic hit, it was right around 97, 98, obviously dropped all the way down to 67 and was working its way back up, but that bounced, as you said, all the way down back to 67, which was the number we saw right after March, April of 20 last year, which is interesting. Of course, inflation is the big reason why that's happening. But as I said, there's good news coming up, and you alluded to the fact that people can't get their stuff. So that means there are order backlogs. That means the economy is going to continue to chug along in 2022.
Right, and inventories will be replenished and the like. I mean, the thing that I think we're most focused on as an investment committee is, the stock market tends to like inflation until the Fed decides to become very serious about it. We know that. We always talk about don't fight the Fed. If the Fed's accommodative, stay with risk assets. And they certainly are. They announced their tapering for November. They announced tapering in December. But these types of inflationary readings, which are new since the last time we heard from Chairman Powell, could force the Fed to perhaps accelerate tapering to get to rate tightening sooner than some people thought. But until they do that, you don't want to overreact and go to cash, because stocks are typically a very good performer during periods of rising inflation.